Welcome back. This is Corporate Radar, and you're tuned in to CNBC-TV18. Well, as we told you earlier, the markets opened under some pressure, but nothing really to worry about. We're down only around 30 points or thereabouts. But as promised, Muthoot Microfin, the IPO opens today. It aims to raise closer to 960 crore rupees from its initial offer. It comprises of a fresh issue of around 760 crore rupees and an OFS of around 200 crores. Mr. Sayeed joins us here in the studio. Hi, sir. Morning. Thanks so much for joining in. Well, could you tell us, post this fundraise, what does your capitalization go to? And also, how does it change the ratio? And with this sort of capital, how long can you continue in terms of your growth?
No, good morning, everyone. Thank you. Pleasure being here. So we are raising around 960 crores, out of which 760 is primary capital. As of September, we are 1,842 crores of capital. So this will take us around to 2,600 capital.
Yes.
And we have been growing at a 36% CAGR for the last 3 years. We are a NBFC MFI focused at the bottom of the pyramid, providing financial access to women folks in joint liability group format. So the focus is financial inclusion, and we are taking digital inclusion also along with it. We are covering 18 states pan-India, and with branches of 1,340 branches spread across 329 districts.
Got it.
Catering to around 3.2 million customers. And the unique aspect about our business is that first of all, the parentage, we have a strong brand name, Muthoot Papachan Group, popularly known as Blue Muthoot. So it has been there for the last 130 years, for last 50 years in NBFC business.
Got it.
And
so just to understand, some more details, this capital that you're raising, it'll hold you in good stead for how long? As you said, you've been growing at the mid-30s. Yeah. Can you keep up the momentum? And this capital holds you good for how long?
Yeah, so I think the growth has been in, like if you look at the industry, the microfinance industry is growing at a 25-30% growth rate, and we have been growing at a 36% growth rate for last 3 years. We surely can maintain as the industry grows. Primarily, we are using this capital to augment our capital base and increase our branch network. So last financial year, we had added around 260 branches. This financial year, in the first half, we have already added 160 branches. So this capital will help us to add more branches, reach out to more customers. So we added around 7.5 lakh new customer last financial year. And this year already we have added around 4 lakh new customers. So we'll be able to reach out to more customers. So significant difference in our microfinance operation is that we are a technology-focused microfinance company. So we have an app called Mahila Mitra app, which caters to the bottom of the pyramid customers. So out of the 3.2 million customers, already 1.5 million customers are on this app. So this capital will help us to increase our reach and reach out to the more customers and use this app.
What is the risk to this 36% CAGR growth that you're seeing?
So I think the market, if you look at it in terms of the whole size of the market, there are around potentially 17 crores household that can be reached out in microfinance in the current definition. And right now, the industry is at around 7.5 crores of household have been reached out to. Definitely, there is huge potential to reach out to, and access to finance is, I think, as India grows, the demand will grow and people will need more finance. So I don't see any challenge as such. But we are a very risk-conscious organization, so we have taken adequate care to make sure that there is no challenge that we face. In fact, we have taken one of the challenge could be the natural calamity event that can happen, but we have a NatCat insurance for all our loans.
So just you're south-focused. We had floods in Chennai which took place. Any kind of impact in terms of your asset quality, in terms of your portfolio?
So no challenges there. We have natural calamity insurance, one of a unique product that we have. We cover all our loans, so all our customers have a coverage of 1 lakh rupees in any kind of an event, whether it's a cyclone, flood, earthquake or anything. If their asset is damaged, they have the cover. We get the installment and they get the cover for their assets. So from that event, we don't had any sort of an impact. And in terms of our geographic presence, we are pan-India kind of an organization, presence in 18 states. 51% of our portfolio comes from South, which is Kerala, Tamil Nadu, and Karnataka. But increasingly, 23% of our portfolio comes from North. Around 13% come from East, which includes West Bengal, Odisha, Chhattisgarh, Jharkhand. We are not there in Northeast yet. And 12% come from West. We are seeing a lot of momentum in North. So increasingly, more new customers would be acquired in that area.
Okay, Sadaf, hi. Tell us a little bit about aspirations and where you want to be in terms of loan book. Say in a couple of years down the line. What's the internal kind of thinking? How big and how fast? And also a little bit of margins. Where will that settle at? What's the steady state margin we should expect?
Yeah, so first on the loan book, we are at 10,800 crores of AUM, and we have been growing in the past at a 36% CAGR, and I think we have put in place fundamentals in terms of a branch network, a very good app and system, so which will help us continue the growth momentum. In terms of margins, we are operating at a 12.39 NIM. And our yield on the portfolio is 22.94%. And we feel that as the interest rate cycle turns, definitely the margins will improve. Part of it definitely will pass on the benefit to our customer, but part of it will also go into the bottom line. The two things which are impacting our profit is, one, the NIM that has expanded in the last couple of years, but secondly, we have significantly automated our operation, so which has really helped us to cut down our cost. Our cost to income ratio has gone down from 64% to 46% in the September quarter, and it'll further go down as
what period has this happened?
FY22.
Yeah.
22 to 20, the current.
Yeah.
So this is a dramatic drop.
Yeah, so a lot of use of technology. We have automated entire operating process. So we operate in a near paperless environment. Only whatever is regulatorily or statutorily required, we give to the customer. Otherwise, the app provides all the information to the customer. With the app, she can request for additional loan. She can check her eligibility. She can check her loan track record. She can check what is the status of kind of her repayment. So this basically, the app is an empowerment tool. Typically in microfinance operation, because these are deep rural area. So the customer are only dependent upon the field officer to interact with the company. But with this app, they're empowered to directly communicate with the organization. This app is available in 12 languages. So local people can use it. We have done a survey among our clients. Almost 84% of our clients have a smartphone.
Okay.
That is at the household level.
Got it. All right. And you mentioned, about this cost to income ratio coming down drastically from the mid-60s to the mid-40s. Where does it stabilize at? Point number one. Point number two, what about your return ratios? The ROE and ROA, both of them are relatively low in comparison to peers. So what's the target number there?
So if you analyze our return ratio, we are at 4.2% in ROA and 23% in ROE. Traditionally also, pre-COVID, we have delivered consistently 4.5% ROA for 5-year period prior to COVID. So we believe that that is something is achievable by this business easily. And with the growth momentum and capital coming in, definitely that will bring in efficiency. We'll continue to leverage on our technology. As I told you, out of the 3.2 million customer, 1.5 million customer are on this app. We feel that 84% of the customer base has this smartphone. So more can come on this app, which will bring in efficiencies of operation, and also cost to income will go down.
Okay, just on asset quality, your 90 DPD, what would it be?
2.37% as of September.
And is it pre-COVID levels? Is it at pre-COVID levels? Give us a comparison on where it is.
So if you look at COVID was, of course, a very big moment. And during that time, peak delinquency was around, our GNP was 7.39%. It has come down to now 2.37%. And this is, and net NPA is at 0.33%. And this is basically driven by our superior underwriting. So we have developed a scorecard with the help of Equifax, understanding the 6.5 crore live customers and their credit behavior, and identifying 40 parameters which influence their repayment behavior, and giving them weightage. So each customer is given a score, and based on that score, they are categorized into 4 categories: low risk, very low risk, high risk, and medium risk. So we focus on low risk and very low risk customer. And typically in lending business, there are 2 types of mistake anybody can make. One is lending to a wrong customer. Second, that is type 1 error. Type 2 error is what we call, you have a good customer in front of you, but you don't give the right amount to that customer. You give them a standard product. So this scorecards allow us to focus on that good customer and allow her to give right kind of loan. If you look at post-COVID, post-June 2021, that is second wave of COVID, which represent almost 97% of our book today. The delinquency GNP has been only 0.67%. So that is the quality of the book that we are maintaining.
All right, Sadad, we leave it there. Good luck. Thank you very much for dropping by into our studios and explaining the business to us and our viewers. Thank you indeed.
Thank you
for
Prashant.
joining in.
Thank you, Nigel.